Folks, this may be the most important video you ever see. No, I'm not kidding and I'm not joking and I'm not just trying to get you to trick you to watching something else. This really may be the most important video you'll ever see. What I'm about to show you is a real heavy-duty hedge fund tactic. I'm not joking. If anybody ever managed a hedge fund or ever ran a hedge fund, I dare you to tell me that the MAR ratio is not one of the most important factors that you need to know. Folks, if you're new to this or if you're a retail trader, a lot of beginners, a lot of experienced traders always talk about profit potential, profit potential, profit potential. But you know what? Risk is very important. And it's really important to be able to understand your risk to reward ratio and understand it the right way. So in today's video, I'm going to teach you and explain to you the MAR ratio, explain to you why it's important, and give you a little bit of a history behind it, and explain to you how it all started and why traders are now using it as opposed to your average metrics. I'll keep this lesson brief because I know many of you are prepping for today's live class. It's happening at noon Eastern. If you haven't signed up yet, now's your last chance to join me live to learn how to find the best high momentum stocks right now. Click the button at the bottom of this page to attend the free class. We're starting shortly. Do it now. Alright, so what is the MAR ratio? Why is it important? What do you need to know about it? What's all this big deal about risk to reward? Well, let me give you a little history, okay? In the old days, and I'm not talking about individual trades right now, I'm talking about your entire portfolio, okay? This is how traders used to evaluate risk versus reward. They would look at their average gains over time, and then they would look at their average losers, all right? Let me write that down. Average. So, for example, let's say that the trader averaged 30% profit per year, okay? All right? And let's say, for example, that the average drawdown, the average downside, the maximum downside of the system, and I'm doing this just to simplify it, was over time, was 15%, the average, okay? That means your ratio, profit to loss ratio or profit to risk ratio is 2. Your average profit is 30%, your average loss is 15%. Divide 30 by 2, you get, divide 15 into 30, or divide 30 by 15, and you'll get 2. So your average risk to reward ratio is 2, okay? Well, here's what happened. In the early 90s, when the stock market crashed, system traders began seeing risk levels that were a lot worse than the average, okay? So what they did was they changed the average risk to average reward to what is called the MAR ratio. They still use the average profit, but instead of using the average risk, you use the worst risk of the system historically, okay? So if the average is 15, but if your worst drawdown was 30, one time in the last 20 years, then 30 profit, 30 risk, your MAR would equal 1. So what changed was we stopped using average risk. We started using maximum risk. MAR stands for maximum adverse risk ratio, all right? So this is a very important matrix that a lot of retail traders don't focus on. What you want to do is you want to take your average profit over time and you want to compare it to your maximum risk, the biggest that the system ever took. You know why? Because it'll happen again. And when I do my systems, when I work my systems, I look for a MAR ratio of 2. Because then in reality, if I can achieve 1.5 or close to 2, I'm doing really, really well. You don't need to have a huge high MAR ratio. But anything above 1 will put your profit potential above your volatility. Now, some traders don't mind volatility and they trust their system. And if that's the case, that's fine too. But I always look at your average profit potential versus your maximum risk. Don't kid yourself. Don't use the average and the average. Use the average profit and the max risk. That's the MAR ratio. It's really simple, but it's important that you think about it in terms of that. And that's why it's important to look at the entire portfolio as opposed to single individual trades. Single individual trades are random. but your portfolio, your position clusters over time tell the whole story. All right, got to wrap it up. We're going live at noon Eastern with the free momentum training class. There's lots going on in the markets, and I'm sharing our plans on how to play it. The sign up link is below this video, and the room's already filling up. Get ready to learn a ton of useful trading information. Click the button below now to join us. Do it now.